One of the best documented asset pricing anomalies is momentum, the tendency of stocks that have outperformed in the recent past to continue to outperform in the near term. The momentum factor was first identified in 1993 by academics Narasimhan Jagadish and Sheridan Titman, who called it relative strength. 4 years later, Mark Carhart included momentum alongside the three original Farmer French factors in what became known as the four-factor model. A 2015 study found that the momentum premium was more prevalent than hitherto believed. Christopher Jetsi and Mikhail Samanov showed how it applied to different sectors and countries, and also to bonds, commodities and currencies, as well as equities. Why then do recent winners tend to outperform the broader market? Several explanations have been suggested. Some say it's primarily down to investor behaviour. There's evidence, for example, that investors take time to react to corporate earnings and dividends announcements. Another possible reason is herding behaviour. Investors who chase returns, the theory goes, provide a feedback mechanism that drives prices further away from fundamentals, causing short-term momentum. Other experts prefer risk-based explanations. They argue that past winners face greater risk going forward and that momentum compensates for that extra risk. So, how has the momentum premium performed over time? A 2017 paper by Elroy Dimson, Paul Marsh and Mike Staunton showed how, since 1926, a portfolio of winning stocks would have generated returns that were, on average, 7.4% a year higher than a portfolio of losing stocks. In the UK, since 1900, the difference was even bigger at 10.2%. For the 10-year period to the end of April 2021, the MSCI ACWI Momentum Index produced an annualized return of 13.62%. The parent index returned 9.76%. The March 2020 crash saw momentum undergo a major correction, which was followed by a substantial rebound. But winning stocks underperformed in the first quarter of 2021, possibly in part because of the sharp moves in the prices of so-called meme stocks like GameStop and AMC. Let's take a look now at the differences between the MSCI ACWI Momentum Index and the main ACWI Index. The most striking difference is their relative turnover. The Momentum Index has a massive turnover of 86% per annum since inception, compared to just 3.92% for the parent index. And of course, higher turnover means higher cost. And note, transaction costs are ignored in the index, but very much a part of real-world investment returns. The Momentum Index currently has a negative exposure to small cap and value stocks and a very low dividend payout. Here are its top 10 constituents in April 2021, compared to the 10 biggest stocks in the main index. You'll see there's plenty of crossover, with both lists dominated by large growth stocks. But the nature of momentum investing means the makeup of the momentum index can change very quickly. In conclusion, short of radical changes in investor behaviour, the momentum factor is highly likely to persist in the future. Bear in mind, though, that unlike the other risk factors, which are essentially bets on relatively unloved stocks, momentum is the exact opposite. It's a tilt towards the most popular stocks. In other words, unlike other factors, it's pro-cyclical. You could also argue that it's a systematic form of market timing, which we all know can be dangerous. So, handle with care is the best advice.